Morning. That's advanced financial accounting. This part 3 in accounting. Before I start part 3, I like to remind you with part 1 and part 2. Okay. If you remember, first you have, when I give this lecture today, this for part 3, continue with part 1 and part 2. Before I continue with this, I will give you some information. First, you need to write notes. I will give you the lecture. You need to write notes. Every time I give you the lecture, write notes in piece of paper, or you have a notebook, write everything I gave it to you in the lecture, because all the exam from my lectures. Number 2, any questions you need to ask, understand, you need to give it to Hiba Hamza or Marina Maher, my assistant. You need to send it to them by email. They help you. If you can't have any help, please ask them again, okay? And don't forget, I give you handout 1 and handout 2. Handout 1, summarize what do I have? Business combination. What do I have? Business combination. You need to know what business combination. You need to know all of this. And handout number 2, I give you something about acquisition of stock and date of acquisition consolidation. You remember, in this part 2, I show you how to prepare the consolidation worksheet. We're going to use it again in part 3. You need to go back again to part 1 and part 2. Okay? Today we have part 3. Part 3, one by one again, please. That's part 3 again. We'll continue with part 3. That's advanced financial accounting. This part cover week 8 and week 9 and maybe week 10. Possible. That means possible we'll have 3 weeks for this one. This one very, very important, because this one basic for the final in exam we do it. We have to go back again, part 1, part 2 and part 3. What about part 3? About part 3 talk about cost method and the equity method. Okay? When I say cost method, what do you mean by cost method? First, what do you mean by equity method? That's something new for you. And first, basic issues like we had before. Remember, I usually give you this before. Basic issues, you have to go theory and the practice. Okay? When you have a theory, you need to know accounting methods for long-term investment in common stock. After, look at this, after date of acquisition, we call it post-acquisition. Remember, in part 2, we'll talk about date of acquisition. In part 3, we'll talk about after date of acquisition. Okay? Also, you need to know, when I say longer-term investment, what do you mean by longer-term and short-term? Longer-term investment in common stock, usually more than 1 year. B company, parent company, they want to invest in subsidiaries. That means they have to put some money for longer term, more than 1 year, 5 years, 10 years. And we need to discuss cost method, what is it, and equity method, that's in theory, definition, meaning, okay? When you come to practice, again, we have how to prepare consolidated financial statements under equity method, not under cost method. We have to do it under equity method, okay? 1 year after acquisition, what are you going to do? And 2 years after acquisition. Start with first issue, accounting for long-term investment in common stock, more than 1 year. Number 1, on the date of acquisition, I assume date of acquisition January 1st, 2005. That's the date, January 1st, 2005. And that date, this happened between 2 companies. In that date, long-term investment in common stock are recorded at acquisition cost. What do you mean by acquisition cost? acquisition cost means also the same meaning, investment cost. That's acquisition cost or investment cost by using purchase method. You remember in part 1, we have purchase. You need to review again part 1, what's the purchase method? How to record purchase method? How is the balance sheet under purchase method? You need to go back again under purchase method. You need to know how to compute or calculate goodwill. You need to know how to do this from part 1 and part 2. And exceptions. This one here, under pooling of interest, this method is not included, but you need to read about it. That means we have a purchase method and we have another method. This method, we call it pooling of interest. This one here, under pooling of interest, long-term investment in common stock are recorded at BV. BV means book value. You see the difference between this one here, purchase method, this one here, book value. That's different. Book values mean the value in accounting books, in general journal and general ledger. Okay. Now, on that date, on the date of acquisition, which is January 1st, 2005, under purchase method, the statement of financial positions, we call it balance sheet, is prepared. Only balance sheet. We have this in part 2. This one here is prepared by using consolidation worksheet. Okay? Take a note, take your time, think about it and review it and see what do you mean by the worksheet. What is the worksheet? I'm going to explain it to you. The same worksheet, we have it in part 2. Okay? Now, let's go for continue. And consolidation worksheet, what is it? You have to know this from part 2. Consolidation worksheet is a draft prepared by accountants outside the accounting books. When I say outside the accounting books of parent company, and it's, what do we mean by outside? Outside means not recorded in account in GJ or GL, not recorded. Why is not recorded? Because the worksheet is a draft. Okay, outside accounting books. Also, the worksheet adjusting entry. Remember, in the worksheet we have a column for the adjustment. This adjustment, look at again part 2. The adjustment, when you have the adjustment, this here adjusting entry is necessary in consolidation process. Why do we need adjusting entry in the worksheet? You have to know what's the reason. The reason is to avoid double counting. Double counting what? Assets and equity of subsidiary company. That means this consolidation, what will help us, this journal entry, I'm going to show you like in part 2, how we're going to do it again in part 3. Okay. Also, consolidation worksheet adjusting entry requires, look at here, requires what? Elimination of stockholder equity of subsidiary. And reclassify. Look at this elimination first and reclassify its assets and liabilities against investment in subsidiary. Go back again, review handout number 2, part 2, advanced financial account. Okay? Remember, we have 5 steps. I will repeat again 5 steps to prepare consolidation worksheet. Okay? And let's go number 2. Number 1, we'll talk about date of acquisition. Number 2, subsequent to the date of acquisition. What do we mean subsequent? Subsequent means after date of acquisition. Subsequent date of acquisition. What do we call this one? We call it post acquisition. That means subsequent date of acquisitions means the post of acquisitions are going to assume 1 year after date of acquisition. What is it? December 31st, 2005. Or 2 years after acquisition, December 31st, 2000. That means we have 2 years. What are you going to do 1 year after acquisition or 2 years after acquisition? You have to go think about this in part 3. Also, mainly after date of acquisition, mainly, we have 2 accounting methods are used after date of acquisition to account for long-term investments in common stock. Okay, that means after date of acquisition, I have a choice. Do I use cost method or I use equity method? Okay. Of course, I have to give you more detail. What's the equity method? What's the cost method? How are I going to apply equity and how are I going to apply equity and how are I going to apply cost method? Each one, how are I going to record it in accounting books? How are I going to report it in financial reports? Okay. That means start with mainly 2 accounting methods are used after date of acquisition to account for long-term investment in common stock. First method, we call it cost method. For cost method, what do you need to know for cost method? Requirement, conditions for simple, we call it simple cost method. Not complex, not complicated, simple cost method. Also, I like to know under cost method, recording cost method in accounting books. Okay, when I say accounting books, means GJ, General Journal, and journal entries in GJ, and journal ledger accounts. You need to know for both of this one. Also, under cost method, I like you to know how to report cost method in financial report and the financial statement. Okay, that's this one. Continue. Base 3, look at the numbers. Base 3, talk about basic equity method. Remember, equity method sometimes more details, sometimes complicated, but usually I give you in this course basic, like this one cost method, simple. This one I call it basic equity method. Okay. What's the requirement for basic equity method? The requirement, you need to know what's the requirement for equity method. That's number 1. Also, I'd like you to know recording equity method in account books GJ and GL and reporting in financial reports, which is income statement, the earning balance sheet, cash flows, all of this, we need to know this. Under equity method, the following financial statements are prepared. Look at the financial statement, not only one statement. Okay. In part 2, we have only balance sheet. In part 3, we're going to have 3 statements. Consolidation, worksheet, review, handout. Number 2, in part 2, advanced financial accounting, 5 steps to prepare consolidation worksheet. What kind of a statement in part 3 we're going to do together? 3 statements, one by one, by order. The first one, consolidated income statement. Something you need to know before you do this, you need to know what is income statement, what's the element of income statement, how to prepare income statement. Okay? And second one, consolidated statement of return to earning. We call this one IS income statement. We call this SRE. SRE means a statement of return to earning. Third one, consolidated statement of financial position. We call it BS, means balance. That's what we need for the exam. What we need to know, only these 3 statements, only these 3. Consolidated income statement, consolidated return to earning, consolidated balance sheet. The other statement, consolidated statement of changes in owner's equity, consolidated statement of cash flows. These 2 statements for reading, but you need to focus only on this one: IS, income statement, SRE, return to earning, and BS means the balance sheet. Now, The big question in part 3 is to know how to make a difference, differentiate between cost method and the equity method. You need to know what's the difference between cost method and the equity method. Okay, that's very, very important in this part 3. Okay, and the main differences between cost method and the equity method. Under cost method, look at here. First, used if the investors owns less than 20% of voting stock or common stock of the investee. What do you mean by this? What do you mean by this? Investee, and that means if we have company A and company B. Okay? If company A owns 15% of shares of company, this one less than 20%. Okay? This is less than 20%. That means in this case, I'm going to use the if the investor, which is company A investor, owns less than 20. What about 18? Yes. What about 19? Yes. Any numbers less than 20% are going to use. 20% of what? 20% of voting stock. What do you mean by voting? Voting stock means the common stock. Okay? Now, let's continue. The investor, remember again, the investor is company A, the investee is company B. Remember again, company A and company B, that's investor, that's the investee. The investor, which is company A, recognizes income from investee. What kind of income? Because he need to take a dividend. He need to take a profit. When take a profit or dividends from investee, when it is received. Received means receive the cash. That's cost method. What else under cost method? Cost amount is not adjusted. Well, what do you mean by this? I'm going to give you example to explain this, but we have something we call exception. What's the exception? I'm going to explain this to you. Okay? That's page number 3. Follow me one by one. Please take a note. I'll give you a second to take a note, write notes, think about it, have a deep breath, and enjoy your life. Let's go page number 4. Page number 4. That's good. Let's look at page 4. What you're going to start with, remember, we'll talk about cost method, okay? Today we're going to continue equity method. Remember again, the exam on part 3 mainly cost and equity method, okay? Remember that's a condition for cost. If company owns less than 20%, I'm going to use cost, okay? What about equity? Look at equity. Used if the investor owns 20% and more. 20 and more. Look at here. What do you mean by 20 and more? Look at this one here. That means if company A again, another example, if company A and the company B owns 25% of B, this one more than 20%. That's right. That means this one here, use investor owns 20 and more of vote. The word of voting stock means common stock. That means common stock shareholders allowed to vote. What do you mean by allowed to vote? Allowed to choose the managers, board of directors. Okay? Second one, for equity method again. Remember, I try to compare between cost and equity. You need to know this. What's the difference? Also, the investors recognize this income from the investee, which is company B, the investor investee, when it is reported. You see difference between cost method? Cost method recognizes when it is received, cash, That means when this one here, when reported mean doesn't matter. Doesn't matter, receive it cash now or later on credit, okay? And the last one for equity, cost amount is adjusted. How adjusted? I keep more details for this one when I give you example. I have to give you example for cost and equity method, okay? What's the general rule? General rule for cost and equity, okay? Let's do it here. General rule, let's put this way. General rule. The general rule for cost and equity, first, I'm going to have 3 levels. This one here, less than 20%. This one here, 20% to 50%. This one here, more 50%. Remember again, we have 3 levels. We have 3 levels. Level 1, less than 20% of common stock. That's level 1. I call this first level, level 1. This one here, I'm going to apply cost method. That's clear. Cost method. Okay? Second one, from 20 to 50, 20, 21, 22, 25, until 50, okay? I'm going to use equity. You understand this? Equity more than 50. What about more than 51, 52, until maximum is 100? That's right. Maximum 100. More than 50 of common stock, apply equity. Yes. Look at here. I go to write equity. Yes. And very important, you need to prepare consolidated financial statement. Look at only why only under this level? Because this one here, company A has a voting interest, and the company A they can control company. That's controlling more than 50%. They're controlling. Okay. Let's go back again. That means 3 levels. Less than 20%, you need to apply cost. Then 20 to 50, equity, and more than 50. Why from 20 to 50? Because we assume company A, that's the assumption. We assume company A can control company B. If from 20 to 50. That means you can say less than 20 cost, from 20 to above, that's equity. Is this clear to you? Say yes, sir. Okay, good. Now, I give you something will help you. If I give you some exams or something, you need to know which is which. I have a choice now. Do I use cost or I use equity? I give you 6 cases. Number 4 here, case studies for cost and equity. These cases, you're going to apply it, but be careful, one by one. Start with case 1. Case 1, assume company A owns 60% of common stock of B. In this case, it's clear. I use equity because more than 50%. That's right. Case number 2, assume A company owns 15% of B. Well, that means I'm going to use cost. That's right. Yes, because less than 20. Case number 3, assume company A owns 60% of B. Look at this one, very important. With no controlling interest. With no controlling interest, let me, no controlling, with no, this one here, with case number 3, with no controlling. Look at this one, 60, but no controlling. When you have 60 with no controlling, that means no controlling, very, very important. They have 60, yes, equity, but with no controlling. When you see this word, no controlling, that means company cannot control. In this case, I'm going to apply cost. Is this clear to you? Case number 4. Look at case number 4. Assume a company owns 15%. Yes, that's less than 20. But with controlling interest, controlling what about controlling, by the way? Controlling means company A can choose the manager of company B. Company A, they can choose the product. They can treat company B as a branch. You understand this? Let's go, in this case, number 4, that's 25 or 35. With controlling, I'm going to use equity. Let's go case number 5. Case number 5, assume a company owns 18 of B. And look at this one. And I ask you in the exam, please use equity. Remember, I'm going to ask you, you are asked to use equity. Then you need to apply equity. No argument. Don't tell me, no. You have to follow what's the requirement. I ask you, use equity, okay? Case number 6. Assume a company owns 80. Okay, 80. 80 means equity. But in the exam, I'm going to ask you, use cost. So that's the difference. When I ask you use cost, that means then you need to apply cost. Okay? Now, we have 5 examples. Example for cost method, example 1, 2, and 3 to cover cost. And for equity method, example 4 and 5, and we have worksheet. Okay? I give you a few seconds to write notes for this one. Few seconds to write notes. Okay? After this, we'll go for page 5. Okay. Well, let me give you, remember again, I give you page number. You need to know page number. You need to write down page number. You need to write notes. That's first example for cost method. Okay? Before you answer, you need to read the question first. What's the question here? Example 1, cost method. He told you, when you read, please put line under each one. A company acquired, how much? 15%. That means less than 20%. In U company. It's clear to you. 2 companies, company E, and company U. That's right. This one, 15%. That's clear. The date of acquisition, when this happened, January 1st, 2003. How much is the acquisition cost or investment to cost? 10,000. Cash or credit? Cash. Both line under cash. U company reported net income or loss and paid dividends as follows. In this example, I give you 2 years, 2003 and 2004. December 2003 and December 2004. When you have net income or net loss, 2003, net income 5,000, for 2004, loss 2,800. Dividend paid to shareholders, 2003, 2,000, 2004, 2,500. 2 years. I ask you 2 questions. Question 1, for year 1, which is 2003, prepare, when I say journal entries, that means debit and credit. In which company? Company A, because company hereby invested in company U. Company in E, accounting books. When I say account books again, that means start with GJ, General Journal, first. Okay? And I'm going to ask you, construct T account. You're going to open T account, yes, in GL, that's T account, to show me investment in you. Okay? We finish number 1. We'll go for second year. Year 2, for year 2, same requirement. Same means journal entries for second year and T account. That's example 1. Write it down first. Write notes. They're allowed to take a copy. I know you can take a copy or whatever, or your camera, but you need to write it down with you, okay? Now, write example first before. What I'm going to do, I'm going to step by step, because it's not easy one. I'm going to show you step by step how to do journal entries. What's the model answer for this one? What's the model answer for this one? You need to know this, all of this, for example one, okay? For example one. Now, start with, that's page 5, it gives you the example. Let's go page 6, see what do we have. In page 6, model answer, again, when I say model answer, that means when you answer in the exam or any other time, you need to follow the assignment here. What I gave it to you. First, using constant method. Yes. Note, before you answer, very important, before you answer, read, and understand the question. First, you need to read and understand what's the question. Just, you didn't go right away, answer, you need to read first, and understand it. Also, read the written requirements. What's the requirements? Requirements mean I ask you, do what? You need to know. After that, after you do this, read, proceed, go ahead, proceed to answer example 1. Okay? That's what I'm going to do now. Example 1, go back again to example 1. He asks you journal entries 2003 first year. When I have journal entry 2003, I need first to record the investment in you. That's right. I'm going to debit cash, debit 10,000 investment in you, and credit cash. Okay. Second one, company is, I need to record. You remember we have two companies. Go back again. You need to go keep the example beside you. The example, what company E and the company U. Remember again, company E. Don't forget the example of company E and company U. Okay. Second one, record receipt, dividend receipt from company E. He's going to enter this one, record investment. He's going to another one, record dividends. When you record dividend received, how are you going to do this one? Cash, debit, 300, and dividend income or dividend revenue, where 300 come from? Come from 2,000 times 15. What's 2,000? You need to go back again to example 1. What's 2,000? You need to go again, if example 1, company U, divide dividend paid, 2,000. That's right. 2,000 multiplied by ownership percentage. What's ownership percentage? Means 15%. That's right. That's why we have this 300. Okay. Now, I ask you again for 2003. Remember, we're still in 2003 again. We're still in 2003. I ask you again to show me T account investment. When I say T, that's T account. Here, yes. T account. When you have an investment debit, yes. Both under debit, yes. Debit, yes. And that's it. 2003. The same number. Remember, this one debit, this one credit. I put here 10,000. That means debit is still debit. That's a balance. What's this balance for? This balance for 2003. That first year. That's right. 2003. Take a few seconds. Write notes. Write the answer. Write the model answer. That's the first one. Journal entry 2003. Record the investment in you and investment in cash, and record the received dividend received from you, debit and the dividend, and T account. How to make T account? That's one here, debit and the credit. Okay, that's what we have. We still have another requirement. What's the other requirement? Page 7. Again, page 7. Okay. Page 7, he asks you, journal entries in account books 2004. That's right. Second year, year 2. This one year 2. Only one entry. Why one? Because the first entry, acquisition costs, we did it already in year 1. We need only year for dividend. Second year, we have only one. What kind of entry? Remember, year 1, we have 2 entries. In year 2, we have only one entry. Which one? Only one entry for 2004 to record dividend received from you. This one here, I'm going to write it first and explain it. Debit cash, 375. Where does this come from? We need to explain this. And the credit debit investment. Why I credit investment? What's the reason? Where does this number come from? We need to explain this. The difference between this one here and this one, it gives me 30. Now, where does this number come from? Where does 345 come from? 675 minus 330. What's 675? Let me explain to you. Investment in you reduced. Put line under reduced. What do I reduce? Make it credit. Remember, investment is a debit because it's an asset. When you reduce it, make it credit. That's right. Look at accounting 1 and accounting 2. Accounting 1 and account 2, you need to know investment in you reduced by how much? 345. Credit. That's good. Now, why? Because, look at here, the reason. You need to know reason. Very important. Because dividend received in 2 years, yes. How much is it? 675 is greater, both line under greater, than share of net income. How for 2 years? How 300. That means we have two numbers. What 75 come from? Where is 330 come from? This before you write this entry, before you need to do calculation, make a table. Okay? This table will help you. What's the table about? This table only for second year. This table, first column, you have year 2003, 2004. Second one, dividend received from you. Last one, share of net income from you. Okay? Put the table first. Start year 1. Year 1, which is 2003. In 2003, remember, in 2003, the dividend received 2,000. That means company A will get 15% of 2,000, 3,000. 2004, they get 2,500, 15%, 375. That means total dividend received for 2 years, that's it, 675. Let's go on other column, on other side. Share of net income from you. Company A, they look at company, they have 5,000 net income, multiplied 15%, 750, and year 4 they have a loss, minus 2,850, 420. Take this one minus this one, it gives you 3. That means you can say total dividend received for 2 years, 675. Total share of net income from you for 2 years, which one is greater? This one is greater. That's right, is greater. That means that's why the difference between this one and this one, how much is it? 345. Okay? That's why we get 345. This one is this one. Okay? Note. Somebody going to ask me what happened if the opposite? What is the opposite? The opposite, if dividend received get less, look at here, note, very important, If dividend received less, say 330, less, it's opposite, less than share of net income. In this case, no reduction in investment. We have only debit cash and dividend income 375. No credit for this one. Now let me repeat again. Little bit again for 2004 only. We have one entry, which is dividend, cash, debt. This one investment, where is 375 come from? This one here to this one here to 500 times 15%, give you 375. And credit 345, where does this come from? Difference between this one and this one. And because this one is greater than this one, I reduce investment. The difference between this one and this one, 30, I put it dividend income. What happens if the opposite? What happens if dividend is less? This one 330 and this one, if dividend received 330, less than share of net income, then what are going to do? What's the journal entry? Journal entry, debit cash and the credit dividend, 375. Okay? Take a note for a second, please. Take a note, a deep breath, and wake up with me. Okay? Now, another page. Another page, I told you in 2004, show me T account. That's 2004. This one investment in you, GL, this for 2004. Second year. That's right. This account, 10,000 came from last year, January 1st, 2004, 10,000. And we reduce the investment. Reduced by how much? This one, 345. You know where 375 come from. That's right. This amount credit, this debit, that means the new balance for investment in you will be 9,650. Because we reduce the investment, we make some reduction here, and instead of 10,000, we make it the balance will be 9,655. Okay? This one, GL. This one, GL in general ledger. Okay? Take a note for a second, please. Now, I'm going to, that's example one. What you're going to do at home, you didn't have to memorize it, you didn't have to, but you need to practice. You can do it at home, you can do it alone. You have the example with you. Yeah, if you need another copy, please send the email to Hiba or Marina Maher or Hiba Hamza. Miss Hiba or Miss Marina will help you. But please be in touch with you too, okay? And explanation, more example, more exercises. But don't forget the lecture. The lecture is very, very important. I do the lectures. I have two assistants, Hiba and Marina will help you. I'm sure the best one will help you. Okay. Now let's go for next page, please. This example I gave it to you. You need to practice this without answer. But I'm going to give you answer. But when you take this example two, try to copy example one. See if you understand first before you answer one by one. Example two again, cost method. Okay, this one here at the beginning 2001. A company owns 60% of B for how much? 20,000 cash. B company brought net income and loss as follows: 2001 cash dividend first, 15,000, and second year 12,000. Net income or loss first year, and so I switch example one for example two. I put this one first and this one second. Okay. Remember again, I told you assume cost. Doesn't matter. With 60, I'd ask you, use cost, assume cost. That means you need to follow cost. Okay, that's right. Now, in this example, we have 2 years, year 2001 and year 2002. Okay? I'm going to do it fast with you. The model answer, the same, one by one again. I go to with you, okay? How to do it? Just write notes first, write the example with you. Write example and put lines the same and keep it with you and Do it many times, please. Do it many times. Don't memorize it. Do not memorize. You need to understand what is it. The same like example 1. Okay? Same like example 1. Okay, now, this one here, that's page 9. Page 10, remember, I told you one by one. Page 10, model answer for example 2 by using cost method. The same. Journal entries in 2001, yes. And record investment, yes. Debit investment, cash. We have this before. Another entry, first year you have 2 entries. Second entry, record dividend received for 2001. All of this 2001. Cash, 9,000. Dividend income. Where's 9,000 come from? 15,000 dividend and time 16%. 60%. Okay. T account, the same. You have only one entry, debit. That's a debit. You put cash, debit, and you put it here, debit again, the balance 2020, no change. That's for first year 2001, first year, okay? What about second year? Second year, remember again, usually 2002. 2002, remember, we have only one entry. One entry for 2002 to record dividend received, only dividend received, okay? Look at the same like example 1, but be careful with the number. Don't mix the number dividend with net income. That's a different story, okay? Let's go for page 11. In page 11, I told you here, we have only one entry. That's right? One entry. First, cash, 12,000, 60%, 7,200. Investment in you again here, this one here, make it credit. When you see this one credit, means reduce, we reduce the investment. By how much is it? By 3,000. Where 3,000 come from? The difference between 16,200 and 13,200. The difference between this one and this one, it gave me this one, 4,000. That's the dividend income. Let me explain to you where this number come from. Look at again, investment in B reduced by 3,000. Where is 3,000 come from? To come 3,000, you need to make a table. That's a table. 2001, first column. Second column, dividend received from B. The last column, share of net income from B. For 2001, 15,000, 60%, 9,000. 2002, 12%, 60%, 7,200. The total amount for 2 years for dividend, that's 16,200. Remember? How much share of net income of B? You're going to say this one here, 25,000, 60%. And this one loss, when you see this one here, means loss. This one means loss, means a minus. This one minus this one, it gives you. You take these two numbers together. Which one is greater? Dividend received is greater. That's correct. This one here, how much is it? The difference between this one and this one, it gives you 3,000. Okay? The same one, I gave it to you just to more explanation to cost. It's very important cost method for any exam, cost method. Okay? Now, let's go for next page, please. Next page. I take this out. Clean this first. Clean this page first. You know how to do this. Please, if you have any question, go back again. Give it to Heba or Marina Maha or Heba Hamza. Miss Heba or Miss Marina will help you all of this thing. But if you need my help, please send the email to Heba or Marina. Mainly Heba. She's a course coordinator. Heba Hamza. Okay. Let's go for this one here. Page 12. Page 12. Page 12, I ask you the same question before. What happened if dividend received less than share of net income? Okay? The same. But What's the journal entry? We have only debit, cash, and no reduction. No reduction investment. If this F, dividend received less, that means that's a journal entry. We still have this one here for second year to show me the investment account. This one here, debit 20,000, credit invest 3,000. Its new balance of investment will be 7. We reduce the investment by 3,000. That means 17,000. Okay. Let's go example 3, the last example in cost method. The last example in cost method. Okay, last example. This example, the good thing with this example, it has some new ideas. So what's the new idea in the example 3? Example 3, it gives you cost method and equity. Well, that means we need to introduce equity now to you. Simple equity and simple cost. This example, I'm going to show you cost method and the equity method, the same information, cost and equity. Pay attention first. Go one by one. Read again. Read again. This one here, our company acquired 80% outstanding common stock of C. What do we mean outstanding? Outstanding means number of shares traded in the market. Outstanding voting stock. Voting stock means the common stock of C. That means we have two companies. Company R and company C. That's right. That means R acquired, how much is it? 80%. That's correct. 80% of outstanding voting stock or common stock of C company. For how much is it? 88,000. Cash. 88,000 represent to what? Represent acquisition cost or investment cost. That's this one. When this happened? Date of acquisition, when this happened? January 1st, 2002. Okay? He gave you some very important information. What is it? What is it? He said the stockholders' equity of C, stockholders' equity of C company was 100,000 at the date of acquisition. What do we mean by stockholders' equity? What is it? What do we mean by stockholders' equity? When I go back again to net asset, when I didn't have asset, I didn't have liabilities. Again, go back again. This example, remember again, accounting assets equal liabilities plus shareholders' equity. That's right. If you have the assets 100, liabilities 30, how much shareholders' equity? 7. That's right. If you take this 100 minus 30, it gives you 70. Again, what's the asset? This one, total assets. What's the 30? Total liability. That means 100 minus 30, it gives you, we call this net assets. Net assets always equal to shareholders' equity. In this example, he didn't give you assets or liabilities. No. He give you only one number, which is what? The shareholders' equity. How much shareholders' equity here? How much is it? That means this shareholders' equity means shareholder always shareholder right notes. Shareholders' equity always equal to net asset. Net asset 70, shareholders' equity 70. That's right. You need to know that. In this example, no asset, no liabilities. Okay? Now, again, read again. Our company acquired 80% of standing stock of C company for 88,000 cash on January 1st. The stockholders' equity, which is equal to net assets, how 100,000 at the date of. What do you mean by at the date of acquisition, which is January 1st, 2002? He gave you additional information, very important for equity method. What is it? He said the excess of acquisition cost over book value. Remember again, we have two items, acquisition cost over book value of net asset acquired. This one represents goodwill. Well, we need to know what's the acquisition cost, what's the book value, and do we have a goodwill or no goodwill. Under equity method, we need to know do we have a goodwill or no, not under equity method, okay? I'm going to use this information for equity method. Also, he told you if you have this, if you have a goodwill, yes, if you have a goodwill, assume goodwill amortized over. Let's go back again. What do by amortized? What's the amortized? Okay, you need to know, remember in accounting, you need to know three things. You need to know three things. First, when I say depreciation expense, when I say amortization expense, when I say depletion expense, you need to know in accounting, you go to finish, you go to the market, look for job. You need to know what is it. You need to know in accounting, you need to know what's the difference. What's the difference between depreciation expense and amortization expense and depletion expense, okay? Depreciation expense for tangible assets such as building, equipment, we call it tangible asset. Tangible assets, we use depreciation expense, tangible assets. What about amortization? Amortization are going to use for intangible assets such as goodwill, yes, and patent, and trademark, and. That means this one, when I say depreciation, that means for tangible assets. This one for amortization means for intangible assets such as goodwill, patent, trademark, trade name, franchises, okay, all of them. What about depletion? Depletion, this one here for natural resources, natural resources. What about natural resources? Natural resources, we have two kinds of natural, above the land and under the land. That's right? Excuse me. When you have above the land natural resources, we have trees, that's above the land. Under the land, we have mines, we have gold, we have gas, we have oil, that's under the land. We have two kinds of resources. Are you going to use depreciation? No. Amortization? No. Are you going to use depletion expense? Remember, when you go to the market, you need to read about accounting for gas and oil especially in Egypt now. In Egypt now, we have a gas, a lot of gas. In Delta, close to Damanhur, Kafr Sheikh, Baltim, all of this, we have a lot of gas. You need to read about natural resources, how we take the gas from this one. On Mediterranean, we have gas. In the Red Sea, we have gas. You need to know this, that we have a leader of the gas now in Middle East, the Egypt now. You have to know, you have to be ready for this and ready for how to know this term. That means this one here, depreciation expense. This one here is telling you, again, let's go again, the excess of acquisition cost over book value acquired represent goodwill, yes. Goodwill, it's an intangible asset. If you have a goodwill, you're going to amortize it over 40 years. In 2002, this one 2001, beginning of the year. This one end of the year. Remember, you have to know beginning and the ending. This ever begin, January, this one ending. You need to answer, look at, you have to read first. C company declared. Declared means they put in newspaper, declared, we're going to do this and pay for each 5 pound or 1 pound, 2 pound. Like a CIB bank, he pay for dividend for shareholders. You need to know how much declared and paid cash dividend. Remember, when I say cash dividend, we have other dividends. You need to know when cash, they pay cash, but they have other dividends. They have a stock dividend. You need to know what's the difference between, I gave you this before, what's the difference between cash dividend and stock dividend. You need to know this. But this case, cash. How much is it? 15,000. Okay, both line under 15. And the reported net income, how much? 35. We have two numbers. You understand the question now? Now, go to requirement. Requirement, I ask you, assume cost method. First one. Second one, assume equity method. We're going to do this example twice. One under cost, one under equity. if you come to cost, I need two entries, journal entries, this one here, and T account. For account to equity, I'm going to show you how to do equity. After I finish this, that's a good example to finish this part. This will be a good example to finish this part. Okay, let's do one by one to finish this one. Okay, now write down first. Write down the example. I go clear it before I give you the model answer. This is a good example. Before I give you equity. Equity has more details, but that's a very simple example to explain to you what's the difference between cost method and the equity method, how we're going to do cost, how we're going to do equity, and all of this we have to think about it. Okay? Now, let's go page. To finish this part, I still have page 14, 15, 16, and 17. We still have 4 pages to finish this file 1 or part 1. Okay? This one under cost method. Okay? Okay. Now, page 14. In page 14, again, this one here, I always give you the middle answer. Even you need to know the difference between this answer and when you do the answer, write it here. If you do draft, calculation, or anything, you do it in this side. This side only for model answer. You need to, under each question, you need to know what is the requirement. Okay? The requirement for this one here, that first requirement, assume cost method. That's clear, cost method. Yes? Is this 1 year or 2 years? That's only 1 year. Remember? It's only 1 year. Journal entries in R, we have 2 companies, company R, and what's the name of other company? Name, you need to go back again, and C, R and C company, okay? Company R, because he's the owner, he invested, he going to debit, this one is to record acquisition, 80% of C, he going to debit, how much is it? Investment in B, 88,000, cash 88,000. This one here, we call this acquisition cost or investment cost, okay? It's written in the example, is nothing new. Second entry, remember I told you first year we have to, this example only 1 year. When you have first year, 1 year, I need 2 entries. First one, debit, investment and cash. This one to record acquisition cost, 80% of C. That's always like this. Second entry, you need to record dividend received from C. When you have a dividend received, this company R, you're going to debit cash, 15,000 multiplied 80%. They can't get 100, but they need to get only 80% because company R owns only 80% of C. That means multiplied by 80. This one here, it gave you cash, 12,000, dividend income, or sometimes I call it dividend revenues of dividend income. Okay? That's. What about T account? T account, yes, I have 88,000 debit and investment in C, and the credit no change, 88,000. That's that first one. Assume cost method. Okay. Now, take a notes, and a deep breath. Think about it and enjoy it and relax and enjoy it and write notes. Because if you understand this lecture, next one will be easy, because next lecture we're going to focus only on equity and the worksheet and other that you need to know today. What's the cost, what's the equity, what you're going to do, how many entries under cost. First year we have 2 entries and we have 1 account here. Okay, let's continue. Next page, please. Remember, in this one we still have another. Okay. Under start equity, very, very important. Write this down, very important. In equity, that's a symbol or basic equity. We're going in this one here, we have first entry under equity, first one, under equity. Remember, under equity. Record acquisition of 80% of C. This one here, 88 and 88. Same as cost method. That's right. Same as cost. Right here. This one, same as cost method. That's right. Look at cost method. Entry 1, investment in C, and the cash. That's right. Second entry, record the share of net income. This one here, I put XXX. This example to only for equity. This example only for equity. What is it? Why only for equity? Let me explain to you. I'm going to write it down first. First, debit investment in C, credit income from C. How much is it? 27,800. 27,800. Where does this number come from? I have to give you more details. How you get before you write anything. An example in number 2, recording share of net income of C. Before you write, you need to do some calculation. Where does this number come from? It comes from 35,000 times 80% minus 200. We need to know what's 35,000. That's why I give you a note. I give you first note number 1. Very, very important, right? Note 1. How to compute. Look at this one here. Question. Sometime I ask you in the exam, how to compute income from C. 27,800. Where does this number come from? Show me in details. In details. Show me where does this number come from in details. Remember again, we're still under equity. Look at the different equities difference than cost method now. Enter number 1 is the same, but enter number 2 is not. Why? Enter number 2, debit investment, yes, but how much is the amount? 27,800. Before I answer this part, I need to do some calculation. What is it? Compute income from C to under equity method. I have a step 1, very, very important. Step 1, remember under equity, I'm going to use purchase method. That's step 1. Step 1, compute valuation differential and the goodwill using purchase method. Remember in part 1 and part 2, remember again, we have only one method, purchase method. Well, we have to show you how I do this. That means you need to find the acquisition cost or investment cost of 88,000 minus book value of net asset acquired. I didn't have asset or liabilities, but I have net assets. Net assets equal to shareholder, that means 100,000. Remember 100,000? You take 100,000, that's shareholder equity, multiplied by 80%, it gives you 80,000. The difference between this one and this one acquisition cost, this one book value as acquired, the difference between two numbers, this one, it gives you 8,000, which we call this valuation differential. That means if I ask you in the exam, compute valuation differential and the goodwill. Before you do goodwill, you need to start with the acquisition cost. You need minus book value as acquired, how I get this one, and you come to valuation. What's valuation differential about? What definition? You need to know definition. Valuation differential is the difference between two values. Which values? Acquisition cost, 88,000, and book value of net assets. That's, we call this difference, give you valuation differential. Minus revaluation increment. What do you mean by revaluation increment? In this example, 0. Why 0? Because that's this one here, that's market value equal to book value. What's the market value of asset liability? They didn't give you any asset liabilities. Market value of net assets equal to book value of net asset. He didn't give me any difference. When he didn't give you any, no difference, nothing, I put 0. If you look at the example again, if you read the example again for a second, please look at the example again. What did he say about this example? Example number 3. He didn't mention. He said any excess of acquisition cost over book value represent goodwill. That means in this case, revaluation increment how much? 0. That means how much goodwill? This is very important. This one, that means we have 8,000 goodwill. Page 16, step 2, that's the annual amortization of goodwill. You remember, we have 8,000 goodwill. You remember? We need to know how much each year from 8,000. We call annual amortization like depreciation, similar to depreciation. Annual amortization of goodwill, I take 8,000, divide by 40 years, give me 200 per year. Remember the numbers now. We have a goodwill, 8,000 from step 1, and we need to amortize it, means put it per years, divided by 40, give me 2, okay? Let's go step 3. Remember these steps, we're going to use it for equity method. This steps for equity method. Step number 3. We need to come to this number, 27,800. Remember, we need to come to this one. We get step 1, step 2, and step 3. This is very important. Step 3, see net income. Net income, it's a given. This number, it's given to you. 35,000, yes. Multiplied by ownership percentage, which is 80%, it gives you 28,000. That's right? 28,000. You're going to deduct from 28,200, it gives you, that's what we need. This number, 27,800. That's why we did the entry. Entry number 2, you remember entry number 2, share of net income from C, 27,800. Okay? Let's go, we need another entry. Remember, in equity method, we have 3 entries. The last entry, you need to record dividend received from C. Dividend received, cash, 12,000. Where is 12,000 come from? 15,000 times 80%, investment in C. That means for equity method, you have 3 entries, okay? Remember this, we have, that's base 16. Base 16, this one is step 2, okay? Take a few seconds, just look at it and see how you do it, how you do calculation. If you want to write notes slowly, one by one, give you just a few seconds to write notes, or you can take pictures or anything, your phone, anything you can do. You need to look at it and study it and contact Hiba if you have any question, or Marina. Start with Hiba first. After this, if you can't see Hiba, you can have with Marina. That's Hiba and Marina, they help me as assistant, okay? One teaching assistant as one assistant, okay? That's what we have. Let's go for next page, please. Next page. Page 17, that's page 17. This one, that's a talk about T account. Look at under equity method. T account, I like you to compare T account under cost method and the T account under equity method. Under equity method, look at here. A T account for investment in C, debit, 2 items, 88,000, 27,800, and the credit, it's always like 3 entries. Each entry, debit investment, yes, 88,000, and debit 27,800, and the credit. We like to know. It's always like this in equity. You have to know what this about, and you come to the end. You come to the end. The balance. This one plus this one minus this one. It gives you the balance 103. Now under equity method, you have debit, the investment account, debit by acquisition cost, that's number 1, and debit by share of net income from C. Remember how you get this number? To come to this number, you need to do 3 steps, very important. And the credit by dividend received, 12,000. At this time, that's all finished page 17. Now, with this one here, it's enough for this example.